Gold has held value for thousands of years. Long before paper money, civilizations used gold as a store of wealth, a medium of exchange, and a symbol of economic power. Yet today, gold no longer backs currency in most nations. Instead, its price is set daily by a combination of global markets, trading mechanisms, institutional influence, and economic fundamentals. There is no single person or government that unilaterally determines the price of gold. The price emerges from interactions between supply, demand, currency relationships, and global financial behavior. For much of modern history, many nations operated under the gold standard, a monetary system where the value of a country's money was directly linked to a fixed quantity of gold. In the United States, the Gold Standard Act of 1900 legally tied the US dollar to a specific quantity of gold. This meant that holders of paper currency could, in theory, exchange it for a defined amount of gold. The purpose was to provide stability, limit inflation, and ensure confidence in currency by anchoring it to a physical asset. However, the global economy evolved rapidly in the 20th century. Economic pressures, global conflicts, and fiscal needs gradually made the gold standard increasingly restrictive for governments. By the end of the Bretton Woods system in 1971, most major economies had transitioned to fiat currency, money that is not backed by a physical commodity, but derives its value from government authority and market confidence. The abandonment of gold backing meant that gold's price would no longer be fixed by government decree, but by market forces. With the end of the gold standard, gold became a freely traded commodity. Its price began to reflect real-time interactions between buyers and sellers in global markets. One of the earliest and most important mechanisms for establishing a widely accepted price was the London gold fixing, which began in 1919. In this system, representatives from major financial institutions would meet twice daily to set a benchmark price for gold. This fixed price became a global standard referenced by traders, bullion markets, and investment contracts worldwide. Over time, the original physical meeting evolved into a more transparent electronic process. In 2015, the benchmark transitioned to what is now known as the LBMA gold price. This price is established through an electronic auction in which participating members submit bids and offers. The point at which supply equals demand determines the price for that session. The LBMA gold price is denominated in US dollars per troy ounce, the global standard measurement for gold trading, and is published twice daily. This benchmark functions as the central reference point for global gold trading. Major financial institutions, sometimes referred to as market makers, participate in the LBMA auctions. These include large international banks and bullion dealers that manage significant quantities of physical and traded gold. Their involvement ensures liquidity in the gold market. That is, the ability to buy and sell without causing extreme price swings. Because these institutions have large operations in global markets, their orders in the LBMA process help establish a price that reflects broad market expectations. Gold is traded around the world, with major trading centers including London, New York, Shanghai, Mumbai, and Dubai. The LBMA benchmark serves as a global reference, but local markets may adjust prices based on currency exchange rates, local supply conditions, import/export duties, and other regional factors. For example, gold priced in euros will differ slightly from gold priced in US dollars or Indian rupees due to currency strength and local demand. In addition to the LBMA benchmark, futures markets play a substantial role in shaping gold prices. Futures exchanges, such as COMEX in New York, allow traders to buy and sell contracts for delivery of gold at a future date. These contracts are based on expectations about inflation, interest rates, economic growth, and geopolitical risk. Because futures markets often involve large institutional investors, their trading patterns, when combined with physical demand, contribute to the overall pricing signals seen in spot markets. It is important to emphasize that even powerful institutions do not control gold prices in isolation. Instead, the price is an outcome of distributed decision making. Banks, traders, central banks, and investors all contribute to price formation through their trading activity. Gold's price moves because of interactions among these participants, not because a single authority sets it. Thus, understanding who decides the price involves recognizing that modern gold pricing reflects a decentralized market structure, where benchmark auctions, futures trading, institutional participation, and global supply and demand converge. No one person sets gold's price. The market does. Gold's price is affected by factors that range from mining production to global economic sentiment. To understand how these elements work together, we must look at what drives demand, what limits supply, and how economic conditions shape investor behavior. One of the primary influences on gold prices is the value of the US dollar. Gold is generally priced in US dollars, so when the dollar weakens, gold becomes relatively cheaper for holders of other currencies, leading to higher demand and prices. Conversely, a stronger dollar tends to depress gold prices because investors can purchase less gold with their currency. Another major influence comes from central bank behavior. National banks hold gold as part of their foreign reserves. In recent decades, several central banks, particularly in emerging markets, have increased their gold holdings as a way to diversify reserves and hedge against currency risk. When central banks buy gold, they signal confidence in its role as a long-term store of value, often supporting upward price movement. Central bank selling, while less common, has historically exerted downward pressure on prices when it occurs. Gold's physical supply also plays a significant role. Most gold enters the global market through mining. Extracting and refining gold is a time-intensive process that involves significant investment, labor, and regulatory compliance. Because mining supply cannot be rapidly increased in response to price spikes, gold's supply is considered relatively inelastic in the short term. When demand rises, whether from investors, industry, or central banks, the limited expansion of supply tends to push prices higher. Investor demand itself takes many forms. Physical purchases of gold bars and coins are common among individuals and institutions seeking a tangible asset. Exchange-traded funds, ETFs, that hold gold provide another avenue for investment without physical possession. Futures and derivatives contracts allow investors to speculate on price changes without owning the metal. When inflation expectations rise, investors often seek gold as a hedge, increasing demand and pushing prices up. In periods of financial stress, such as during economic recessions or geopolitical crises, gold's role as a safe haven asset typically attracts more buyers, further elevating price. Futures markets deserve particular attention because they reflect projected expectations about the future state of the economy. Traders in these markets respond to macroeconomic indicators such as interest rates, inflation reports, employment data, and geopolitical developments. These contracts, while not directly setting the cash price of gold, influence market expectations and often move prices through changes in trader positions and sentiment. Gold is also sensitive to macroeconomic indicators. Inflation, in particular, has a strong historical correlation with gold prices. When inflation is rising, paper assets like bonds or savings accounts can lose real purchasing power. In such environments, gold is often viewed as preserving value, increasing demand. Interest rates have a similar effect. Lower real interest rates reduce the opportunity cost of holding gold, which itself yields no interest, making it more attractive relative to interest-bearing assets. Geopolitical events add another layer of complexity. Wars, trade disputes, sanctions, and regional instability can spur investors towards gold as a protective asset. Even when the physical trading of gold is unaffected by conflict, the psychological effect on investor sentiment can be significant. Uncertainty tends to increase demand, raising prices, while increased certainty and economic growth can reduce demand relative to risk assets such as stocks. In this context, gold's price reflects a balance between long-term expectations and short-term reactions. On one hand, structural factors such as mining supply and central bank policy provide a steady backdrop. On the other hand, investor behavior and macroeconomic conditions cause volatility and fluctuations. Modern gold pricing is therefore shaped by the interaction of many forces. Benchmark auctions that establish global reference pricing futures markets that reflect future expectations. Central bank policies and purchases, currency strength and exchange rates, investor demand for safe haven assets, supply limits from mining and production. No single authority controls these forces. Instead, gold's price represents a global consensus, a reflection of collective decisions made daily by market participants all over the world. In closing, understanding how the price of gold is determined requires looking beyond the idea of a single decision maker.